By the end of this video, you will know exactly what 99% of people watching the US-Iran war news today do not know, and that determines whether you make the right call or spend the next 6 months wondering why you missed it. Bombs fell on Tehran, and right now millions of people are staring at gold and silver prices, asking the same question: do I act? Do I wait? Am I already too late? Here is the problem. That is the wrong question. And the financial media covering this event, all of it, including the sources you trust, is answering the wrong question too. The right question is not whether gold and silver move, they already have. The right question is whether this holds or whether it reverses and destroys everyone who bought into the fear. Those are two completely different outcomes. And the answer has nothing to do with Tehran, nothing to do with Trump's statement this morning, nothing to do with the UN emergency session happening right now. It has to do with a 33-kilometer stretch of water, and once I show you why, you will never read Middle East news the same way again. Here is what actually happened. Around 2:30 a.m. Eastern Time, February 28th, Trump announced major combat operations in Iran. Not a warning strike, major combat operations. Targets confirmed across Tehran, Isfahan, Karaj, Kermanshah. Pentagon named it Operation Epic Fury. Israel called it Operation Roaring Lion. Reuters, Washington Post, Al Jazeera all confirmed within hours. Iran hit back immediately. Ballistic missiles at Israel at U.S. bases in Qatar, Bahrain, Kuwait, the UAE, Al Udeid Air Base in Qatar, U.S. Central Command's forward headquarters, 10,000 personnel, was targeted. And Iran's Revolutionary Guard issued a warning that no ships would be permitted through the Strait of Hormuz. Hold that last sentence, we are coming back to it. Because that warning, not the missiles, not the political statements, that is the only variable in this entire situation that actually determines where prices go from here. But before we get there, the thing financial media is completely missing today. This conflict did not start this morning. Gold was already above $5,000. Silver had already recovered significantly. Iran's Revolutionary Guard already conducted live-fire exercises closing parts of the strait in February. CNBC confirmed it. So what markets are pricing right now is not surprise, it is confirmation. And history is very specific about what confirmation does to a fear-driven rally. The data runs against everything you are hearing today. Gold spikes on geopolitical shock every time. Fast. But whether it lasts depends entirely on one thing, whether the conflict produces persistent inflation, not fear. Inflation. These are different things and markets treat them completely differently. Russia invaded Ukraine, February 2022. Gold jumped from $1,900 to $2,100. By September of the same year, it was below $1,700. 7 months. Because the direct economic consequences turned out more contained than the initial shock implied. Iraq 2003, same pattern. Gulf War 1990, oil spiked to $40, then collapsed when the conflict ended faster than anyone expected. The fear premium is real. It is also temporary unless something specific happens to make it structural. And right now you are probably thinking, okay, but this feels bigger than those. Maybe it is, but feeling bigger is not the mechanism. The mechanism has a name, and it runs through a specific piece of geography. The Strait of Hormuz is not an abstraction. It is a 33-kilometer choke point through which 20 million barrels of oil and petroleum products move every single day. 20% of all global seaborne oil trade, confirmed by the U.S. Energy Information Administration. CLR data puts crude alone at 13 million barrels per day in 2025, which is 31% of all global seaborne crude. Qatar routes its entire LNG production through this waterway. 84% of everything moving through Hormuz goes to Asian markets: China, India, Japan, South Korea. Iran controls the northern shore. The shipping lanes fall partly within Iranian territorial waters. Iran has genuine legal and physical leverage here. Its parliament voted on closing the strait. Its navy already demonstrated what it is willing to do in February. Goldman Sachs says oil tops $100 with a meaningful disruption. JP Morgan puts a full blockade at $120 to $130. Bloomberg Economics documents roughly 4% oil price increase per 1% supply reduction. But here's the analytical point almost nobody is making today. Lombard Odier's chief investment officer for EMEA published this week, and what she said changes the entire picture. A full Hormuz closure costs Iran too. It shuts their own oil exports, their primary government revenue. It invites overwhelming U.S. military response against Iranian naval assets. The incentive structure runs towards selective harassment, GPS interference, targeted shipping attacks, not full blockade. This is the Hormuz variable. Not can Iran close the strait. How far along the spectrum from harassment to closure does this conflict push? because that spectrum maps directly onto the difference between a temporary oil spike and a structural inflation event. Only the structural inflation event produces a rally with staying power. Three scenarios, institutional analysis. This is what determines whether this week's opening move is the beginning or the peak. Scenario 1, rapid de-escalation. Strikes achieve objectives in days. Iran retaliates, but salvos are largely intercepted. Oman's diplomatic channel, reportedly showing significant progress as recently as late February, re-engages. Strait stays open. Oil spikes $10 to $15 and retreats within 2 weeks. Gold holds for a few weeks, then consolidates. Silver's fear premium fades faster than gold's. This is the Lombard Odier base case. Scenario 2, sustained strait disruption. Conflict extends. Iran harasses shipping without formally closing the strait. Tanker insurance rates spike. Asian refiners scramble for alternative crude. Oil price impact becomes persistent. Gold enters sustained upward pressure. Central banks accelerate accumulation. The gold to silver ratio at 59 to 1 starts compressing as silver catches up. Scenario 3, full escalation. Tail risk. Low probability. Iran effectively closes the strait. U.S. military campaigns to force it open. 20% of global daily oil supply disrupted for weeks. Oil goes to 120 higher. Inflationary shock largest since 1973. Gold stops being an asset class and becomes a primary institutional allocation. Institutional consensus. Scenario 1 is the base case. Scenario 2 is the risk to watch. Scenario 3 is low probability and would rewrite commodity markets for years. Those scenarios apply to any crisis in the last 30 years. But there is something about the silver market specifically in 2026 that none of those previous scenarios ever encountered. Something the analysts building those frameworks have not explained clearly. If you stop here, you have 70% of the picture. That is exactly how the most expensive mistakes happen. The Silver Institute confirmed 2026 as the 6th consecutive year of silver supply deficit. 6. Cumulative shortfall since 2021 above 820 million ounces, equivalent to an entire year of global mine production consumed beyond supply. COMEX registered inventories dramatically lower than their 2020 peak. Industrial demand from solar, EVs, AI infrastructure growing at rates that make previous cycles look modest. New mine supply takes 7 to 15 years to develop. Most people hear supply deficit and assume prices go up automatically. The more precise insight is this. What a deficit of this scale creates is the structural floor. In every previous geopolitical shock, when the fear premium faded, silver had nothing to catch it. Industrial supply and demand were balanced or in surplus. Silver fell straight through the safe haven trade back to wherever fundamentals said it belonged. Today, the fundamentals are at a multi-decade extreme. The floor is structural, not emotional. That is a different risk profile than anything we have seen in a comparable event. But there is a third dimension. One that does not appear in any conventional supply-demand model. Not in the Silver Institute reports, not in anything financial media is covering today. I am calling it the permanent demand problem. Every other form of industrial silver demand, solar panels, EV batteries, consumer electronics, enters a recycling stream at end of life. Theoretically recoverable. Military silver consumption is categorically different. Silver in precision guidance systems, targeting computers, radar arrays, advanced weapons circuitry. When that hardware is destroyed in combat, the silver is vaporized. It does not go back to a refinery. It does not re-enter the supply chain. It is permanently removed from above ground inventory. Gone. Silver is the most electrically conductive element on Earth. More than copper. More than gold. That property makes it not preferable, but irreplaceable in the electronic systems that define modern warfare. These are not applications where you substitute a cheaper material and accept lower performance. They are applications where silver's specific properties are the reason the system works. When a conflict goes kinetic, emergency procurement contracts pull silver out of available supply. The Department of Defense does not sell it back. It installs it. The silver is consumed permanently. And the silver market is small, roughly $50 billion total, compared to gold at over $10 trillion. In a market that size, it does not take enormous capital to move the price hard and fast. And this is exactly the moment most people make the most expensive mistake. 3 structural reasons why this market is different. Natural reaction is to act immediately. But the market anticipated that reaction. It placed 3 specific traps right here, 3 decisions that feel completely rational right now that history shows are the most costly ones investors make in a geopolitical event. Trap 1. Panic buying at maximum fear, assuming worst case is guaranteed. It is not. Scenario 1 remains the institutional base case. If de-escalation plays out, the fear premium unwinds and the people who bought at peak urgency give back significant ground. The investors who get hurt most in these events are not the ones who stayed out. They are the ones who bought at exactly the wrong moment. Trap 2, treating defense stocks or oil producers as obvious plays. Oil prices that surge during conflict often collapse sharply when it ends, sanctions ease, supply normalizes. The move that looks obvious at peak fear is usually already priced. You are not getting ahead of the market, you are buying what the market already bought. Trap 3, full cash waiting for clarity. In an environment of dollar weakness, persistent inflation, and structural supply deficits, cash loses purchasing power every month this drags on. Waiting for the perfect entry is not discipline. It is a slower, quieter loss that never shows up as a red number on your screen. So here's what you actually watch, not headlines, not political statements, not the UN session, one number, the oil price. Rising oil means the Hormuz variable is tightening, scenario 2 territory. Falling oil means it is loosening, scenario 1 playing out. Everything in this market follows from that single input. The long-term direction for gold and silver does not change based on which scenario plays out. 6 consecutive years of silver deficit. Central bank gold accumulation at the highest pace in decades. Mine supply that cannot respond quickly. Dollar under sustained pressure. All of that was true before this week. It will be true after the headlines move on. The geopolitical situation changes the speed, not the direction. The gold to silver ratio sits at approximately 59-1 right now. In the 2011 bull market, it compressed to 32-1. The math of what that compression implies at current gold price levels is something most mainstream financial media will not put on screen. The historical precedent is documented. Whether and when it plays out depends entirely on which scenario the Hormuz variable selects. The Hormuz variable is the mechanism, the structural floor is the context, the permanent demand problem is the dimension almost no analysis today accounts for. Watch the oil price every morning. That one number tells you more than everything else combined. Nothing here is financial advice. Nothing is a recommendation to buy or sell anything. This channel exists to explain how systems work, so you can think clearly when everyone else is reacting. The systems are the story we will be watching.